Today I'll show you how to generate passive income with cryptocurrency. We'll cover everything from beginner-friendly options like exchange saving accounts to staking, to more advanced strategies like DeFi lending and liquidity provisioning. I want to stay current on the latest passive income earning methods in crypto, so I gathered together about 20 of the top YouTube tutorials, and then I started to create a custom knowledge base of everything. First, I asked the AI to organize all the various ideas from everybody into categories, and I asked if there were any holes that I could add to in the information. And this led me to a deeper search where I went back and I found another 20 really good tutorials, really amazing resources, and I put those into the knowledge base that really provides a complete picture. And then I asked the AI to give me an overview that'll explain how these methods work, reveal the potential risks involved, and give us a heads up on the crypto tax implications for each of the strategies. The answer to this turned into a report called Earning Passive Income with Crypto, Methods and Risks, and I've turned that report into a PDF that you can get for free. There's a link in the description down below. And then I asked the AI to create a podcast-style conversation to explain all of the best strategies, from the simple to the most complex. I have the podcast queued up, and I have to say that I'm so glad that I did this deep research. It certainly has altered my passive income earning plans for 2025. So let's get started. I recommend that you grab that PDF down below so you can access all of the resources that we talk about as you listen to the podcast.
Imagine this. Your crypto could actually be earning you more crypto while you're, doing just about anything else. Sleeping, working, maybe even traveling.
Yeah, it sounds almost too good to be true, but it's really the core idea behind passive income in the crypto world.
Exactly. And that's what today's deep dive is all about. We're aiming to give you a shortcut to understanding 6 distinct ways you can potentially tap into this.
And we know you want to get up to speed quickly, find those aha moments without getting totally bogged down in jargon. So that's the goal here. We've looked through a bunch of sources to bring you a clear, structured look at earning passively.
Right. So our mission today, unpack 6 different categories. We're going to start with the stuff that's, easier to get into, lower risk, less techie stuff. And then we'll gradually move towards the more complex, maybe riskier strategies. We'll also touch on taxes where it fits and compare similar methods so you can see the differences.
Get ready then. We'll cover everything from just holding crypto in certain ways to diving deep into decentralized finance and the potential yields. They can sometimes really blow traditional savings accounts out of the water.
Okay, let's jump in. First up, what's often seen as the most beginner-friendly path, staking. What exactly is happening when someone stakes their crypto?
Right, staking. At its heart, it's about locking up your crypto to help operate a proof-of-stake blockchain. You're basically contributing to the network's security, helping validate transactions.
Okay.
And for doing that, you get rewarded. Usually you get more of the same crypto you staked. You can kind of think of it like a crypto savings account, but often with, potentially better interest rates.
And how easy is it for someone, maybe someone new to crypto, to actually do this? Is it super technical?
Well, that's one of the big pluses. It can be surprisingly straightforward, especially if you go through the big centralized exchanges. They've really streamlined the process.
Right. Heard of those. So what kind of options are we looking at on these platforms? And what about returns, the APYs?
Yeah, they offer staking for a whole range of different cryptos.
Right.
Binance, for example, they have both locked and flexible options. Locked usually means you commit for a fixed time, maybe for a higher APY. They sometimes have these limited time deals too. Like we saw one mentioned for something called the Cow Project at 43.8% APY, which is huge, but obviously temporary.
Oh, okay.
But even their regular stuff, you might see maybe 1-3% on stable coins, could be higher on more volatile coins, often with those lockup periods,
And Coinbase and Kraken, similar deals.
Pretty much, yeah. Coinbase offers staking too for things like ETH, Solana, Cardano. The source mentioned APY is up to maybe 5.7% there. But keep in mind, Coinbase takes a cut, like a 25% commission on your rewards.
Ah, okay. Good to know.
Kraken supports staking for about, I think it was 17 cryptos, with APYs potentially hitting 23% on. The nice thing about Kraken is often no minimum lockup, except for ETH 2.0 staking, I believe. So a bit more flexibility there sometimes.
Okay, so basic idea, lock it up, earn rewards. But then there's this other term floating around, liquid staking. How's that different?
Liquid staking. Yeah, that's a really interesting development. It tackles the main downside of traditional staking, your assets being locked up and unusable.
Right.
With liquid staking, you use a specific protocol, and when you stake, say, your ETH, you get back a different token, a liquid staking token, or LST. Like Steth from Lido is a big one.
Okay, Steph, so it's like a receipt.
Exactly. It's a token that represents your staked ETH plus the rewards it's earning. But the key thing is, this Steth is liquid. You can trade it, use it in other DeFi apps, lend it out, while your original ETH is still staked and earning rewards.
That sounds pretty useful. So the benefit is basically keeping your options open, maintaining liquidity.
That's the main one, yeah. Your capital isn't just sitting there totally locked. Plus, you don't have to worry about running your own validator node, which is, frankly, pretty complex.
Makes sense. Are there like extra risks that come with liquid staking compared to just regular staking on Kraken or somewhere?
Definitely. There are trade-offs. You're adding smart contract risk because you're interacting with another DeFi protocol. If there's a bug in Lido's code, for instance, that's a risk.
Okay.
There's also market risk. The price of your Steth, for example, could drift away from the price of actual ETH. It usually stays close, but it's not guaranteed. They call that de-pegging risk. And yeah, there might be fees involved with the liquid staking platform, and sometimes getting your original ETH back might still involve a waiting period. So more moving parts.
Gotcha. Now, I've heard people talk about real yield when discussing staking. What does that mean? Is it just marketing?
That's a great question. And no, it's not just marketing. It's actually a really important concept. Real yield means looking at the rewards you get after accounting for the inflation of the token itself.
Inflation, like them printing more tokens.
Exactly. Some projects just print tons of new tokens to pay out high staking rewards. But if the token supply is inflating super fast, your rewards might not actually be increasing your purchasing power. That's not real yield.
So you want yield that beats the inflation rate.
Precisely.
Yeah.
You want yield above the debasement rate.
Yeah.
Ethereum, for instance, after its move to proof of stake, has a very low issuance rate, so its staking yield is often considered closer to real yield. Always look beyond the headline APY number.
That's a really good point. Okay, quick detour taxes. If I'm earning these staking rewards in Canada, how does that work?
Right, taxes. Always fun. In Canada, generally, staking rewards are treated as income when you receive them.
Not when I sell them.
Correct. The value of the rewards, at the moment you get them, that's income for that year. Then, if the price goes up later and you sell, that increase is usually treated as a capital gain.
Okay, so track the value when received and report it.
Yep, keeping good records is key. Penalties for not reporting can be rough. And of course, this is general info. Always best to talk to a tax pro for your specific situation.
Understood. So, summing up staking, seems like native staking, maybe via an exchange, is pretty low risk, relatively speaking.
Yeah, because it's tied directly to how the blockchain works, it's often seen as the lowest risk way to earn yield in crypto. But like we said, liquid staking adds those extra layers: smart contract risk, market risk. Still lower risk than some other things, but not zero risk.
Okay, that makes sense. Let's move to category 2, lending. Seems simple enough. Lend crypto, earn interest. What's the lowdown here?
You got it. The concept is familiar, like lending money, but you're lending crypto. You can do this through centralized platforms, similar to the exchanges we talked about for staking.
Like Binance.
Yeah, Binance often has lending options. Or there are dedicated crypto lending platforms. But you can also use decentralized finance or DeFi lending protocols like Abuv or Compound.
So centralized versus decentralized again, are there specific platforms known for lending? The outline mentioned a couple.
Right, like Heiler was mentioned. They seem to advertise pretty high rates, up to 18% on some cryptos and stablecoins, weekly payouts. They even had some really high numbers listed for specific tokens like ZRO at 30% or even BTC at 12%.
Wow, 12% on Bitcoin sounds significant compared to, well, 0 for just holding it.
It does. Another one was CoinDepot, offering compound interest, different lockup terms, potentially up to 24% on stablecoins like USD, EUR, GBP ones. They also claim to be fully insured, which is interesting. They'll always need to read the fine print on that.
Definitely. So the interest rates sound way better than my bank savings account.
Oh, absolutely. The potential returns are often much, much higher than traditional finance offers. But
there's always a but. What are the risks?
big ones. The main one is counterparty risk. If you lend through a platform, you're trusting them. What if they go bankrupt or get hacked? We saw this happen. Remember BlockFi? Celsius. People lost a lot of money.
Yeah, those were huge collapses. Ouch.
Exactly. So that trust you place in the platform is a major risk factor. And the other big one is just the volatility of crypto itself. Let's say you lend out some altcoin earning 15% interest.
Okay.
But then the price of that altcoin crashes 50%. Your interest earnings aren't going to cover that loss.
Yep.
You could end up with less value than you started with, even while earning interest.
Right. The underlying asset value matters hugely. Okay, and quickly on taxes for lending interest. Similar to staking.
Generally, yes. Interest earned from lending crypto is typically treated as regular interest income. So in Canada, it gets added to your income and taxed at your marginal rate. In the US, same idea, often considered ordinary income, just like bank interest, basically.
Got it. Okay, so staking, lending, relatively understandable. Now we're getting into providing liquidity to decentralized exchanges, or a DXS. Sounds more involved.
It is a step up in complexity, yeah. Providing liquidity is essential for how DXs work, unlike Coinbase or Binance with their order books.
Right, where buyers meet sellers directly.
Exactly. DXs use these things called liquidity pools. Imagine a pool with two different tokens in it, say ETH and USDC stablecoin.
Okay.
As a liquidity provider, or LP, you deposit both tokens into that pool, usually in equal dollar value. So maybe $500 of ETH and $500 of USDC.
Why would I do that? What does it achieve?
Your deposit provides the liquidity that allows other people to trade ETH for USDC or vice versa directly with the pool. These DCs use algorithms called automated market makers, AMMs, to figure out the trading price based on how much of each token is in the pool.
Okay, so I'm enabling the trading. What do I get back?
When you deposit, you get back special tokens called LP tokens. Think of them as your claim check, representing your share of that specific ETH's DC pool.
And the incentive, why lock up two assets?
The main reward is earning a slice of the trading fees. Every time someone swaps ETH for USDC in that pool, a small fee is charged, and that fee gets distributed to all the LPs in proportion to how much liquidity they provided based on their LP tokens.
Ah, okay. So you earn fees.
Yeah. And sometimes there are extra incentives. A DEX might give you its own governance token on top of the fees just for providing liquidity.
Now, I've seen some crazy high APRs advertised for LP positions on some days, like hundreds of %. Is that real, or is there a huge catch?
That's a very good observation. You can see incredibly high APRs sometimes, yeah. Often it's for newer, maybe riskier pairs, or like meme coins that suddenly have huge trading volume.
Right.
So an example mentioned like 277% APR on some pair on the Orca DEX. Also, strategies like concentrated liquidity, where you provide liquidity only within a specific price range, can boost your fee earnings if the price stays in that range. But yes, there's usually a catch.
Which is, what are the big risks here? This sounds riskier than staking or lending.
It generally is. The number one risk unique to LPing is called impermanent loss.
Impermanent loss. Okay, that sounds ominous.
It can be. Basically, if the price of the two tokens you deposited changes significantly relative to each other after you deposit when you go to withdraw, the total value might be less than if you had just held the original two tokens separately.
Wait, so I can lose money even if the prices of both tokens go up?
Yes, potentially.
Yeah.
If one goes up way more than the other, the AMM formula effectively rebalances your holdings within the pool, meaning you end up with more of the less valuable token and less of the more valuable one compared to just holding. It's impermanent because if the prices return to the original ratio, the loss disappears. But if you withdraw while they're diverged, the loss becomes permanent.
Wow. Okay. That's crucial to understand. What other risks?
Well, you still have smart contract risk, like with liquid staking or DeFi lending. The DAGX protocol itself could have a bug. There's asset risk that tokens you deposit could just plummet in value. And especially with new high APR pools for unknown tokens, there's rug pull risk.
Rug pull, like the developers just run off with the money.
Exactly. They create a token, attract liquidity with crazy APRs, and then drain the pool. That's why you see warnings about pools with like 400% APR being potentially garbage. High reward often equals very high risk.
So impermanent loss is the big one. Are there ways to minimize it?
Yeah, there are strategies. One popular one is to provide liquidity for pairs of assets that tend to move together in price, like stablecoin pairs, USDC, USDT, or maybe ETH and a liquid staked version like Steth. Since their prices are correlated, the risk of divergence and thus impermanent loss is lower.
Okay, that makes sense. Any other strategies?
Some people use yield aggregators. These are platforms, Beefy Finance was mentioned, that can automatically take the fees you earn from LPing and reinvest them back into the pool for you. Auto compounding. This can sometimes help offset impermanent loss over time, but it adds another layer of platform risk.
Right. And taxes for LPing sounds like it could get complicated.
It can be, yeah. In Canada, the guidance is still evolving, but often just receiving the LT token when you deposit might be considered a taxable event. You might owe income tax on its value then.
Seriously? Just for getting the receipt token?
Potentially. And then later, when you withdraw your assets and accumulated fees, any gain compared to that initial value could be a capital gain or maybe even business income, depending on how active you are. Definitely need careful records and probably tax advice here.
Okay, definitely getting more complex. Which brings us to category 4, yield farming. The description says it's beyond basic liquidity providing. What does that mean?
Yeah, yield farming takes LPing and adds more layers. It's generally a more active strategy. You're not just parking your assets in one pool. You're often taking those LP tokens you got.
The receipt token.
Right, and instead of just holding them, you're putting them to work somewhere else to earn even more rewards. It's about stacking yields from different sources.
So I provide liquidity on DXA, get LP tokens, then I take those LP tokens and stake them on platform B.
Exactly. That's a classic yield farming loop. Platform B might be offering its own token as a reward for staking those LP tokens. So you're earning trading fees from DexA, plus you're earning Platform B's tokens.
Okay, stacking yields. What about that restaking liquid staking tokens thing mentioned? Like with Eigenlayer?
Right, that's another even more advanced layer. Remember liquid staking tokens like stETH?
Yeah, the receipt for staked ETH.
So platforms like Eigenlayer let you take that stETH, which is already earning ETH staking rewards, and restake it on Eigenlayer to help secure other services. In return, you potentially earn additional rewards from Eigenlayer, maybe points or future tokens, on top of your base ETH staking yield.
So it's like yield on yield on yield.
Kinda, yeah, but you see how the complexity is building up. And the risk.
Definitely. Every extra step sounds like another place something could go wrong.
Precisely. Yield farming significantly increases your smart contract risk exposure because you're interacting with multiple protocols. You're layering protocol risk on top of asset risk, on top of maybe even blockchain risk if you're bridging assets. It's a high-risk, high-reward game, potentially.
The outline also mentioned yield derivatives and vaults. Quick explanation.
Sure. Yield derivatives, Pendle is a platform doing this, let you basically separate the yield component from the principal of a yield-bearing asset. You can trade just the future yield, effectively logging in a rate or speculating on rates changing. It's complex, very volatile, really for advanced users.
Okay, probably not for beginners. What about vaults?
Vaults are designed to make yield farming easier for users. You deposit your crypto into a vault, say on Beefy Finance or Urine Finance, and their automated strategies handle all the complex moving and staking across different protocols to try and maximize yield for you.
So they do the farming for you?
Essentially, yes. For a fee, of course. It simplifies things. But you're trusting the vault's strategy, their security, and you might face issues getting your funds out quickly if the market turns sour, depending on their strategy's lockups.
Okay, yield farming definitely sounds like the deep end of the pool. Requires a lot of research and risk tolerance.
Absolutely. It's active, complex, and carries significantly higher risks than just basic staking or lending, especially on centralized platforms.
Right. Let's shift gears a bit. Category 5, running nodes, specifically mentioning staking as a service. This sounds very technical again.
Running your own validator node on a proof-of-stake network is very technical, yes. You need significant technical skill to set it up, maintain it 24/7, keep it secure. Plus, you often need a very large amount of the crypto to stake as collateral. If your node goes offline or messes up, you can get penalized, slashed.
So probably not something the average person just decides to do one afternoon.
Generally, no. It is a serious commitment. It offers the most control, sure, but it's demanding.
So where does staking as a service fit in? Is that different?
Staking as a service is basically what most people use when they stake through platforms. You're delegating your stake to a professional node operator. Think Lido for Ethereum, or even the staking options on Binance, Coinbase, Kraken.
So when I stake on Coinbase, they're essentially providing staking as a service.
Exactly. They run the complex node infrastructure. You just delegate your coins to them or pool them with others, and they pass along the rewards to you, minus their fee. It lets you participate in staking rewards without the technical headache or the huge capital requirement of running your own node.
Okay, that makes sense. The outline also mentioned strong token nodes or Cardano nodes. Are those just examples of running your own?
Yes, exactly. Those refer to running your own independent validator or service node on those specific networks like Strong Block or Cardano. It's the self-sovereign route, earning rewards directly from the network protocol, but again comes with those higher barriers to entry, technical skill, and capital. Most passive income seekers will use the delegation staking as a service model.
Gotcha. Okay, final category number 6, arbitrage. It sounds like something from traditional stock markets too.
It is, yeah. The concept is identical. Arbitrage is exploiting temporary price differences for the same asset on different markets. In crypto, it means buying a coin on exchange A where it's cheaper and simultaneously selling it on exchange B where it's slightly more expensive.
Pocketing the difference.
Pocketing the difference minus fees. The key is that these price differences usually only exist for moments, maybe seconds or minutes.
Can you walk through an example again? How would that work practically?
Sure. The source mentioned one maybe you have USDT stablecoin on Binance. You see XRP is trading slightly cheaper there than on, say, a smaller regional exchange. So you quickly buy XRP on Binance, transfer it to the other exchange.
Which takes time.
Which takes time, exactly. That's a risk factor. But assuming it arrives quickly and the price difference still exists, you sell the XRP on the second exchange for USDT, hopefully ending up with slightly more USDT than you started with on Binance.
Yeah.
Same idea was mentioned using Litecoin.
That sounds like you need to be incredibly fast, have accounts and funds everywhere, and know exactly what you're doing.
You absolutely do. Speed is critical. You need accounts funded on multiple exchanges. You need to understand withdrawal times, transfer fees, trading fees on both sides. Often, serious arbitrageurs use automated trading bots to constantly scan prices and execute trades instantly. Doing it manually is extremely difficult to capture those tiny, fleeting spreads consistently.
What are the main risks then, besides just being too slow?
Well, being too slow is a big one. The price gap closes before your trade completes. Transaction fees can eat up your potential profit if the spread is too small. Exchanges might have withdrawal limits or delays that trap your funds. Transferring coins between exchanges takes time and costs network fees. And there's slippage risk. The price moves against you between when you see it and when your order actually executes.
So definitely not passive in the set it and forget it sense. Sounds very active.
Highly active, yes. It requires constant monitoring, technical tools, often bots, significant capital spread across venues, and a strong understanding of market mechanics and platform risks. It's a way to potentially generate income, but it's far from the passive nature of, say, simple staking.
Wow. Okay. We have really covered a lot of ground here. From, the pretty straightforward staking on an exchange.
All the way to complex, multi-layered yield farming and the super high-speed game of arbitrage.
Yeah, it's clear there's a whole spectrum. 6 categories, each with its own potential rewards, definitely its own risks, and different levels of technical skill needed.
Exactly. We've seen options suitable for beginners just dipping their toes in, wanting lower risk, all the way up to strategies for DeFi power users who are comfortable managing complexity and higher risks for potentially higher yields.
And hopefully for everyone listening who wanted to get that efficient overview, this deep dive has clarified the landscape a bit, maybe sparked some aha moments about how crypto could potentially be working for you.
For sure. But remember, this is really just the starting point. If any of these categories, staking, lending, LPing, whatever caught your interest, the next step is crucial.
Yeah.
Do your own deeper research.
Right. Don't just jump in based on our chat.
Please don't. Really understand the specific platforms, the specific risks involved. Maybe start small, with lower risk options first while you learn. And definitely dig into concepts like real yield and impermanent loss if you're looking at staking or LPing. They're key to making informed choices.
Absolutely. So as we wrap up, maybe a final thought to chew on. We're seeing this explosion of digital assets, right? Could these passive income strategies we've talked about today represent like a fundamental shift, a new way for individuals to potentially grow wealth outside the old traditional banking and investment channels?
It's a fascinating question. Are we seeing a democratization of yield generation, maybe? Or just new forms of risk?
Yeah, lots to think about. So based on everything we've unpacked today, what specific area, what strategy are you now most curious to go and explore further?